Good afternoon. My name is Byron Slessor. I'm a Distribution Director at Channel Capital, and thank you for joining us for the final session of our Asset Allocation virtual series this afternoon, focusing on alternative growth investments. So there's been a lot of discussion about a low yield world, lower return expectations across all asset classes going forward, and perhaps the typical 60-40 investment portfolio of bonds and equities is broken going forward. This is all in the backdrop of an ageing baby boomer population, approaching retirement with the need for capital preservation and stable yield in retirement. So alternatives have increasingly been used by some of the world's largest and most sophisticated institutions to help meet portfolio objectives for investors. For example, the $163 billion Australian Government Future Fund has a 29.2% allocation to alternatives and private equity as of the 30th of September 2020. The challenge is that alternatives are inherently more complex, and investors' understanding of the risk and return characteristics of these investments is paramount before making an allocation in the portfolio. So to make sense of it all, today I'm joined by three experts in the areas of asset allocation, market neutral Australian equities, and Australian and New Zealand mid-market private equity. So the intention of today's session is to give an insight into the virtues of both liquid and illiquid growth alternative investments to add genuine diversification to a balanced portfolio. So joining us today from Sage Capital is Managing Director and Chief Investment Officer, Sean Fenton. Sean's got over 25 years of experience in markets and is arguably one of Australia's most experienced long-short Australian equities investors. Prior to establishing Sage Capital in 2019, Sean was the lead portfolio manager of the Tribeca Alpha Plus Fund for over 13 years, from inception in 2006 through to Sean's departure in 2019. So Sean and team manage a market neutral Australian equities fund called the CC Sage Capital Absolute Return Fund. And this fund is designed to give investors exposure to the investment skill of Sage Capital and focuses on generating absolute returns regardless of the direction of equities markets. And Sage Capital utilise both quantitative and fundamental inputs equally, with the intention of constructing style neutral portfolios with strict risk management. Our second panellist today, joining us from Genesis Capital, is partner and founder Chris Yu. Genesis Capital are a specialist private equity investor in Australia in healthcare and technology. The team focus on these two fast-growing segments of the economy, bringing a wealth of knowledge to the table. Uniquely, Genesis see themselves as business builders, not passive investors. They look to generate significant value by supporting the companies with both financial and human capital over the long term. Chris has over 13 years of management consulting and private equity experience. Prior to Genesis, he was a partner and member of the investment committee of Crescent Capital Partners and a principal at Bain Capital. And finally, today's session will be moderated by Craig Ferguson. Craig runs a global macro advisory and asset consulting business that will be well known to many of you on the call, called Antipodean Capital. He's renowned as one of the premier asset allocators and macro thought leaders in the market, and his models have generated substantial outperformance over many cycles. Craig has been working with institutions, family offices, wholesale and retail advice businesses for the last 15 years with Antipodean. Prior to this, Craig was the head strategist of currency at ANZ Investment Bank from 2003 to 2005 and was the top-ranked currency forecaster in Australia over this period, according to the Peter Lee surveys. Prior to this, Craig was a currency and bond trader at JP Morgan for nearly a decade, from 1994 to 2003. So Craig constructs bespoke portfolios across all asset classes, including alternatives, and provides some insight today on how he approaches investing in alternatives, where alternatives investments sit in a portfolio, and the weightings towards alternatives in these portfolios. So just briefly before I pass over to Craig, today's session there'll be questions at the end that I'll moderate. So feel free to put any questions in the box at the bottom of your screen if you have any questions during the session. But other than that, I'll hand over to Craig. Thanks, Craig.
Thanks, Byron, and thanks also to Channel Capital for holding the session, and welcome everyone. So I really wanted to start out the session today by posing 5 questions, and also trying to look at 2 or 3 different sorts of portfolios, whether you're a family office, an endowment, or an investment advisor, as to how others use alternative investments. Those 5 questions, we'll go through them, but when we get to the end of them, I'll ask Sean and Chris for their responses, and And right at the end, with the last 10 or 15 minutes, we'll have a Q&A session. So either feel free to ask questions on chat. If I see them during the presentation, I'll try and address them. If not, we'll address them in the last 15 minutes. Those 5 questions I think are really important. And, I think the first is with, as Byron mentioned, current market conditions in terms of bond and equity valuations being the most expensive we've seen in 30 years. Where do alternative assets sit in portfolios? The second is, what are the return expectations that we can expect from alternatives? So we'll ask Sean and Chris what they think should be the most appropriate return expectations for market neutral, private equity, those sort of assets. Then how do we divide the alternatives world up between growth and defensive, between liquid and illiquid? And also, fourthly, and importantly for you guys who are on the call, how do you choose an alternatives manager and what should you be looking for? What are the characteristics that are required for a good growth manager or for a good defensive manager? And finally, how should we measure managers and by what metrics? What are the pitfalls to be avoided with alternative managers? And also, what are the signposts, which are pretty crucial that Sean and Chris think should give you an indication to avoid a particular manager in their certain space? So with that being the structure for the day, I really just wanted to start the process out by addressing that first aspect. So as Byron mentioned in his first introduction, the 60-40 equity to bond portfolio has had extraordinary returns over the course of the last 30 or 40 years. In fact, probably even longer, back to the 1980s. So with cash rates globally around the world at zero, with 10-year bond yields below 1%, and with equity markets in the US and in Australia at the highest levels of private equity PE valuations that we've seen over 30 or 40 years, what's the choice for an investor, an advisor, family office, or an endowment? So really what I wanted to start out with was asking Sean first. Sean, can you provide your thoughts on the bond and equity market valuations, where they currently are and where they stand, and where you think alternatives will be helpful in managing return and also downside expectations for portfolios going forward?
Yeah, sure. Thanks, Craig. Look, certainly bond markets are a bit of an enigma, and the difficulty, I think, in looking at all financial markets is that they increasingly become less free, particularly over the last decade. So central banks are playing a much greater role in terms of fixing the price of assets, and particularly the price of bonds, and the way that then flows through to all asset classes. So it's very difficult to say that that bonds can represent value when they've got virtually no running yield and just the potential for downside losses. I wouldn't put it past central banks to engineer negative rates going forward and continue to drive capital gains, but that's probably another debate. In terms of where equities sit, equity market valuations in terms of historical multiples, be it PEs or cash flows or EV to EBITDA, are all at historic highs. But in comparison to bonds, they actually don't look that ridiculous. Just that level of intervention's been so great. But it certainly does leave us cautious on the prospects for returns from pure beta going forward in terms of equities. And I think the big things to grapple with are to what extent central banks remain committed to supporting asset prices, but also the potential for good news to be bad news. So we've seen vaccine news yesterday, equity markets rally a bit, jump around, but a lot of rotation there, and bond markets selling off. So the risk going forward is that historical risk parity return of bonds and equities being negatively correlated and smoothing things out has gone away, and central banks have intervened to the extent that everything's very correlated. So there's still potential for economic growth and returns from risk assets going forward, but your natural diversification and an asset allocation sense in terms of a mix between bonds and equities and cash and other asset classes is not going to give you the level of diversification going forward from what you have had in the past. So I think investors need to think more outside the box in terms of not just how they get returns, but how they get more consistent returns and a good risk-reward balance across the portfolio. And that's where we really see alternatives stepping up and having a huge role to play. Alternatives do open up a whole range of investment strategies that can be far less correlated than what is just being driven by central banks across broader risk asset markets. And I think investors really do need to be looking at allocating more towards alternatives across a range of different areas in terms of broadening their portfolio out, looking for different sources of return, and also protecting themselves from the binary outcomes that you're going to see from central bank policy on risk asset markets going forward.
So Sean, in that sense, within your space, the market neutral long short space, are you, when you do your fundamental and your quantitative screens, are you seeing particular areas of the market as a sectoral, from a sectoral perspective, that are quite cheap, or are you actually, and you're seeing others that are expensive, and how are you positioning that?
Yeah, there's definitely some big dichotomies within the market, particularly between value and growth. You've obviously heard of the death of value managers being heralded, which is often a turning point in markets. That's sort of reached fever pitch lately. And certainly you saw that rotation yesterday in the markets, where good news, higher bond yields has driven rotation. So obviously stocks that are more growth orientated, the valuation impacts of having basically zero negative real yields, what that can do to long-term DCFs, and the short-term valuation of stocks with future growth and the assumptions that the market will make about future earnings and the way it will price that is creating massive valuation premiums in parts of the market, and other parts of the market that are filled with cyclicals or financials that are less leveraged might be offering good yields, but largely ignored in that sense. So certainly it's a dimension, both of potential return but potential risks, that we're very focused on. So we do measure our portfolio across those different dimensions in terms of value and growth, and make sure we're not tilting too aggressively. We don't just want to do a toy and cost bet across the market in terms of what central banks are going to do. But certainly when you get state changing information like vaccines that are successful, we can get economies reopening, social distancing removed, and potentially some of the last leg of stimulus and monetary support unwound. That does promote the case for value over growth, and the rotation we saw yesterday continuing on. So we're certainly conscious of those risks and want to be tilted a little bit in the portfolio that way in terms of tilted towards value and earnings recovery, and insure ourselves against the impact of higher real bond yields on higher growth stocks with big valuation multiples.
Thanks, Sean. That's a really good window into how the portfolio is positioned. So I'll turn it over to Chris here. And Chris, we've heard a little bit about how public listed markets are overvalued, and sectoral tilts obviously need to be pretty important when you're positioning. What's the state of the unlisted market and the private equity opportunities you're seeing? Are you still seeing relatively modest valuations, high valuations, low valuations? Does it differ by sector? Can you give the audience a bit of a guide as to what you're seeing and what you're thinking?
Yeah, definitely. I think on the investing side, it really comes down to where you're playing out from a size perspective. And so there's certainly been a shift in larger buyout funds and larger managers who over time have effectively become large asset managers. They're competing in pools of capital and with a weight of capital that ultimately has meant that their return hurdles, if not publicly, at least within their walls, has come down as they look to compete against public markets for assets. And so we see it, and it's a cut above where a mid-market operator plays, in which I can talk to those dynamics. But I think certainly above us, you are definitely seeing those dynamics and really manifest itself in assumptions that they may make and what they may overlook in terms of their risk profiles as they seek to make investments. And so I think it's a difficult job for a large private equity firm who is really under pressure to deploy capital to sit out of the market for too long. And so inevitably, I think those pressures come to play. In different ways, I think what it also manifests itself in is the use of leverage. And so, super low interest rates means lots of leverage available. And that kind of creeps into the risk profile of the investments they make. And as time has told over time, at some point when the music stops, I think that comes to bear in terms of the ultimate returns for equity in those structures. If I turn to maybe a slightly different part of the market, where we operate, and that would be, mid-market and looking to build up to businesses that, potentially other public markets or larger private equity investors would be interested in. It's not completely oblivious to those effects, but I think what you're seeing is more fundamental valuations. You continue to be able to kind of work through an investment thesis that both builds value into the business itself, and so it's kind of impervious to market dynamics. I think you're not banking on market trends in order to make your return. But also, to some level, you're more in the real economy and talking through to, real cash flows, what the outlook for that is. And I think increasingly what I've observed is a huge disconnect between what asset valuations are to what you're feeling down on the ground in these different segments and industries. And so I think in these times, in some ways, it, at least in our view, makes for better opportunities in terms of more fundamental value-based investing from our perspective.
You're muted, Craig.
Oops, sorry about that. Everyone's done that before. I think we might move to the next slide. So if Byron, you can pop up the endowment portfolio. What I thought would be useful would be just to go through that and highlight how the future fund, how universities, for example, think about their liquid and their unliquid portfolios, and how certain states of markets being overvalued, like we're talking about in terms of bonds and equities, then prompt different asset allocation decisions. So if I'll run through this slide pretty much from left to right, and if you can look in the top left, you can see the size of the top 5 endowments in the US, Harvard down through to Brown, and in the bar chart just next to that, you can see the sort of return rates that those portfolios generated until mid-2019. These endowments don't report very frequently, and when they do, they report in calendar year terms. But it may be a little bit hard to see, but on the right-hand side, you can see Yale made 5.7%, which actually wasn't too bad, to be honest, until the middle of 2019, bearing in mind it would have taken in all of the volatility of the second half of 2018 as well. Penn, Harvard and Dartmouth, you pretty much could have thrown a rug over them between 6 and 7%. But Brown on the far left had a 12.4% return. The interesting thing is that middle pie chart is from Brown. So it gives a pretty good indication of where those returns have come from. And it's not necessarily been from public equity, but it's actually been from alternative assets. If you look at that pie chart, you can see that private equity amounts to about 22% of the Brown portfolio. Absolute return, so that tends to be hedge fund strategies, is about 31. Real assets, you can think of infrastructure and property there. Fixed income 8, cash 5, other 1, and public equity just 24%. So if you're an endowment when you're on the call, or even if you're in a family or an advisor, you see a pretty different asset allocation from the endowments in the US than what you normally would see in those categories, certainly in Australia. If you look on the left-hand side, you can get an indication of what the actual returns over that period, that 1 year period from mid-18 to mid-19, were across the asset classes. So, for example, public equity 5.9%, and this is obviously not just for Brown, but it's for one of the other universities. Private equity 16%, hedge funds 5.5%, real estate 9.3%, natural resources. And natural resources are an interesting one because some of the endowments have them as a core long holding, as an inflation hedge, just as they do with bonds and tips. 5.7%. Other real assets recorded a negative return in this particular endowment, and the endowment overall returned 6.5%. So I think this was actually Harvard or Penn. So you can already see the difference in return profiles from bonds and equities with with the alternative asset classes returning significantly higher. And that tends to be, I'll quickly run through, and I don't want to deviate the conversation too long, but I'll quickly run through, the normal return expectations of each of those asset classes. So just so you can get a guide. So public equity, for example, you're talking 8 to 9% returns over the last, 30 to 40 years with a volatility of somewhere between 11 and 13. Private equity, you're looking somewhere between, let's just call it 13 and 18%, with a far less lower volatility. So probably a volatility of somewhere between 5 and 10. Hedge funds, that number's about right. Most of the data we see around from hedge fund indices is around a 6% return with about a 5% standard deviation. Real estate, again, you're probably seeing somewhere around 8 to 10 over a long period of time in terms of returns, but with a lower standard deviation, especially in unlisted rather than listed real estate. Natural resources, well, that cycle comes and goes with the passage of commodity prices. Bonds and tips, well, it's pretty safe to say that with 10-year bonds in the US and Australia below 1% and with inflation running at 1.5%, bond and tip returns going forward over the next 3 to 5 years will not be 5.7%. They'll probably be somewhere closer to 0 to 1%. And in real terms, they'll be negative. Other real assets and clearly cash, cash is going to be 0 for 3 to 5 years. So automatically, just by going through that return and standard deviation framework, you can get a pretty good idea of where a low volatility, higher return asset class or portfolio asset allocation comes from. If you look to the right, and I'll probably take one or two more minutes on this, but you can see the future fund portfolio, and as Byron mentioned, they have a pretty diverse portfolio. Bottom right there, you can see Aussie equities very low at 6.5. Developed markets 16.8, EM interestingly 8.4, and much of that is in China. Private equity 14, property 5.6, infrastructure at 7, debt at 7.5, alternatives reasonable size at 15.1, and cash at almost 20%. And one of the reasons why the cash is so high, it's not normally as high as that, it's normally somewhere between 10 and 15, is that the future fund has been cognizant of the dislocation that we've seen in equity markets over the course of the year, and has kept powder dry in terms of being able to deploy to liquid markets when it's opportune. Safe to say that they, like most of other investors, probably only got a week-long chance to allocate in late March to deploy cash. So look, I think that gives a pretty good indication of the sort of portfolios we're starting to see and the sort of usage of alternative assets within the endowment sector. So maybe if Byron, the team can take that off the screen, I'll just go back to asking questions. So I've just given you a run through of some of the return and volatility expectations across the alternatives universe. But, Sean and Chris, you're active in the liquid markets, Sean in particular, market neutral. What sort of returns and standard deviations do you think those sort of strategies should be offering over the course of the next 1 or 2 years going forward?
There's a huge range of possible outcomes across the alternative space in terms of return profiles and different product structures. So our absolute return fund, we run around about a 8 to 10% volatility target and target a Sharpe ratio around about 1. So we're targeting around about 10% returns. It's fair to say, though, that you can structure alternatives in many different ways and run high volatility targets, and there are certainly many out there that do. I think when looking at return expectations, it's always just worthwhile looking at them in terms of the amount of risk that you're taking. So Sharpe ratio always a very good metric in terms of that ratio of excess return to volatility. Saltino ratios in terms of looking at drawdowns and downside protection volatility exposure as well, give you an indication of short-term risks. So what you've got to be conscious of as an investor is not just what your return targets are, but how much risk that you're doing there. Also, obviously, the liquidity that comes to bear there as well, and the sort of trade-off that you might take between less liquid alternatives with high return targets versus liquids where you can move in and out more quickly, and quite often will accept a lower Sharpe ratio just for the liquidity benefit.
Chris, how about the private equity space? Those return profiles, 13 to 18%, something like that, standard deviation lower. Is that realistic in your space? And do you think over the course of the next couple of years, obviously private equity is more liquid and has longer lockups, but so probably 1 or 2 years is a bit short. Maybe over the next 5 to 7, are you thinking those return targets are reasonable?
I think they are, and I'd say from a endowment fund or an investor's perspective, that would reflect the kind of the mixed outcome of a range of private equity firms they're investing in. And I think if you take the typical top quartile of private equity funds, they continue to consistently deliver and target north of 20% IRRs. And one of the key benefits of longer dated strategies is really the ability to time entries and exits in a way that's in the best interest of investors. And so I think at the moment you're seeing lots of exit activity in our portfolio included, because it's a great time. I think you have a real sense for the real economy, you see asset valuations where they are, and it makes sense for you to focus on that. In other times in the market, it's better buying. And so the ability over a 4-year investment horizon or over an 8-year fund to be able to have the luxury to kind of think through and work through those cycles, I think works to the benefit of private equity in particular. If I think about our returns, we have consistently through the history of our investing delivered, north of 3 times, north of 25% IRR. I think in the industry, you continue to look at that benchmark at a 25% target IRR as the standard by which you should be measuring yourself. And so definitely in how we're seeing the market today and the opportunities over the next 3 or 4 years, we don't see any reason that you'd need to derogate from that. I would say that that's different from a large pension fund looking at their stable of managers and looking at the very performance and averaging out to a slightly lower return. But that's how we think about the world from a private equity perspective still.
Yeah, thanks, Chris. So one of the interesting things that I tend to find with clients when they show me their portfolios is that they'll sit there and say, we've got bonds, got equities, and then we've got alternatives in the middle. But they may have, for example, very few defensive alternatives, or they may have an all growth, or they may have all defensive and no growth. And, quite as a result of that, quite often what you get is a portfolio that's not balanced appropriately for return, but also for risk and other metrics. Sean, you mentioned just in that your answer before about Sortino ratios and Sharpe ratios. Obviously, return's key, but these other variables around risk and measuring risk and correlation are really, really helpful, I think, for alternative managers to focus on. Things like alpha, the degree to outperform the market, beta, the degree to which you go up and down with the market, correlations in particular with growth assets. You're in the growth bucket in market neutral and long short, so effectively you're competing with equity-like returns. What do you think apart from Sharpe and Sortino are the sorts of other variables that are relevant for comparing a growth asset like equities with a growth alternative like you?
Yeah, it's very interesting how you make that comparison. So whilst we're trying to grow capital and sit in that growth alternative bucket, because we're market neutral and actually have zero beta exposure, we've got a very different risk profile than the broad equity market. So often alternatives are thought of as riskier and more volatile, and running 8 to 10% volatility for sort of a long short equity manager is quite high compared to what a long only equity manager would do. But because we've stripped out that beta, we actually run a lower overall volatility level of the broad market. So even in normal times, the broad equity market will be sort of low to mid-teen volatility. So we're actually delivering a set of returns with a level of information that's generally superior to the equity market over the long term at a lower risk level. So that's the way that we position things and look at it. But there's also many other aspects of risk that you need to look at and consider when looking at a manager. So as you said, there's a whole range of style risks and market exposure, but the things that we really focus on when controlling our risk and what it's worth looking at managers and the way they do it are things like leverage, market exposure, diversification, and style neutrality. And they're all very important aspects of risk. So it's great for the manager to go out and deliver great returns, but if they're just doing that by leveraging themselves to the market and timing market exposure, that's a far more difficult thing to do repeatedly. As we've all discovered, investing is always a bit harder when you do it in reality as opposed to what the initial concept may be. The future's never quite as transparent as you think it may be. So from our perspective, successful investing always comes from diversification and having a broad range of alpha or investment ideas. So the ability to implement a whole range of different investment ideas in something like the liquid alternative space, or the equity space, is really key to consistent performance. So having a broad investment process that's repeatable, but being able to take positions across a whole range of different stocks, capture a whole lot of investment ideas that are either germane to the particulars of that company or the industry or something that's developing, something that you have investment insight into. Being able to do that repeatedly, so having a broad portfolio with good risk control that's not just leveraged to the market, using market leverage to drive returns, that it's not overly style leverage, so you're not taking simplistic bets on one outcome, but broadly representative is going to deliver more consistent returns through time. So diversification of positions, process, risk control are all important aspects of fund construction that we pay close attention to, and I think is a real differentiator of managers who can deliver consistent returns through time versus those that deliver great returns for a while, like a long-term capital management might just leverage up one investment idea 100 times, like Russian bond spreads to develop markets, and one day just completely blow up and most of the global financial system with it. So there's some of the key things that we look at and focus on ourselves.
Rightio, thanks, Sean. Look, I think it's interesting, because Sean comes from the liquid growth alternatives bucket, and Chris obviously comes from the more illiquid growth alternatives bucket. So I think the same sort of questions really should be given to Chris. So Chris, firstly, what are the metrics that you use in the private equity space to judge whether your portfolio and your returns is delivering what you say you can deliver? That's the first question. And then secondly, obviously, private equity has illiquidity, longer lockups. It's often a closed-end nature structure. The returns that you're talking about with your fund are obviously substantial, have been substantial. Do you find that that's a substantial enough return to compensate for the illiquidity? And also, do you think, so that's the second question, so you might want to remember that. And then the third question is there an opening for managers in the illiquid alternative space, whether it's private equity or venture capital, to provide more liquid open structures? And how doable is that from a return perspective? Does it actually cut down returns or not? So I think the first question was around the metrics. And if maybe you want to start there and then move on.
Yeah, definitely in the private equity industry, I don't know that there's as well established a structure around Sharpe ratios or otherwise that relates to kind of measuring some of that. I think ultimately you're focused on a few things, the core return metrics around IRR and your money on multiple. But I think also importantly, one of the negative perceptions sometimes in private equity is, how are these things being valued? Unrealized returns on assets that are, up to the manager to justify their valuation upon, and how real is that? And so I think a key measure of a strong performing private equity manager is realized returns, and also how quickly they're able to return capital. I think a good manager may be investing their fund for 3 or 4 years, but by the time they get to year 3, they should have hopefully returned a good amount of capital. And so really from that point onwards, you're returning in excess of that. And I think what a lot of fund managers get caught in is just a continued accumulation of assets that can't be realized for whatever reason. And so we always focus on those 3 metrics, but in particular making sure we're looking to real and realized returns. And I think some of the best regarded Australian private equity managers are not too attached to the companies that they're building, the investments that they're making, and recognize that their job is to invest capital and then exit at the right time to return capital to investors as well. I think the second question was around premiums for illiquidity. I think no doubt, it is an illiquid asset class. We often have conversations with our investors around, ways in which we might need to and could try to address that. But I think in reality, in order to execute the investment thesis and value creation that a private equity manager has in mind, they need the time to be able to do it. It's disruptive to have to pull up midway and think about how to provide liquidity. And so it is definitely would be a negative to any investment kind of structural model to try to provide artificially created liquidity events along the journey in light of the strategies that are at play. And so I think historical returns, the level of premium, you showed it yourself in terms of the returns of those different asset classes. I think they've demonstrated that the model works. But I think it's definitely something that investors need to go in eyes wide open around the price that they pay for that. I think one of the evolutions I'd say has been to try to find ways to provide more liquidity. And that's happened in different forms. I think there's been, investment strategies that are private equity-like in nature, but investment structures and LICs and other things that are liquid in nature. And so to allow a little bit of liquidity in how that investment makes its way through to that pool of capital. One of the things that we focus on is taking on investor relationships, but along that journey, if we deploy that capital, that's invested in the strategy, you're in for the ride on that particular investment. But in terms of their commitments outside of that, if you don't want to be along for the ride anymore, then that's fine. You can kind of exit the mandate. And so I think in different ways, managers are looking to try and meet some of those needs of investors to not have their capital so locked up, and that I think is starting to evolve in the market these days.
So Christian, just on that, so do you manage that or address that by, for example, running a wait list of investors who potentially want to come in and then you match them up? Is that what you're referring to, or something else?
Yeah, in 2 ways. So there's a well-established practice around secondaries in terms of existing units in a fund, in a private equity fund, and there's a market there for those secondary investors to pick up those units. That's pretty well established. Actually, what we do is we take commitments and mandates. We always make sure we have an amount of capital we have visibility over for the next deal or next couple of deals. But to the extent that those mandates wish to devote their capital or allocate their capital elsewhere, that's completely fine. And we just make sure that we always have line of sight to the next investor to come on board and continue that journey with us, and structure our investments accordingly so that investors can participate along that journey. It's an element of liquidity around an issue, which is committed funds that are not yet deployed, and providing some flexibility around that. I think it's hard for us to go all the way to say, you've put capital into an investment, now I want liquidity. How do I get liquidity immediately? I think that's a harder thing to solve for. But I think there's models evolving to try to meet some of those investor needs.
Yeah, that's interesting. It's a good insight there. Byron, if we can just have up the next 2 slides, I'll quickly run through them because I'm conscious that we've got 20 minutes longer in the call, and we want to have about 10 minutes at the end. We've got a couple of questions left, and then mainly the Q&A at the end. So the interesting thing about this slide too is that it's not just endowments, but family offices. And they share a similar sort of bias. So if you look at that pie chart on the left, you can again see cash relatively low at 7%, fixed income around 12, developed markets about 4. So you tend to find that families have more income needs for the original founder of the family office, for example, and siblings. So you tend to have a bit more fixed income, which is based on income requirements. Equities in developed markets and developing markets are probably around 30-35%. And this is from the Global Family Office report. This is a large report of thousands of, or hundreds, I think it is, or thousands of family offices globally. But you can see equities still probably hovering around the 30% level, private equity around 11. But the interesting thing with families is that they tend to do a lot of it direct. So it can often be people that they know who are seeking funding for new opportunities. And private equity funds is relatively less at around 8%, but still private equity is around 18%. And then real estate tends to be high because families often tend to make a lot of their wealth out of real estate historically. So that's around 17%, but then they tend to have lower hedge fund allocations and other estimates. So you can see how it's different from endowments to families, and that's because of the underlying difference in the nature of the end client, essentially. And you can see also in that right table, and again, this is expected return, actual versus expected returns. You can see on the bottom, the total average portfolio return for this large group of family offices from 2018 to 2019 was 5.4%. Index benchmark was 2.9. In terms of actual expected returns there, which is the left column, which is shaded brown, you can see fixed income returns were very modest, and this is before obviously where we are now, so they're probably inflated by higher yields. Equities were pretty flat. Direct and venture capital, private equity 16, private equity funds 11, hedge funds 2.3, real estate 9.4, and REITs 5.7. And down in the commodities section, there was kind of rats and mice everywhere. But I think the point is an interesting one again, which is that regardless of whether we look at endowments, and admittedly we've only looked at 18, 19, but part of my job is to look back over longer periods of time, the return profiles of these investments, and you can see consistent patterns, especially in private equity, venture capital, and real estate, that return profiles are significantly higher. If we just move on from that slide to where investment advisors currently sit, and I think probably most advisors on the call would probably fit into somewhere on this chart, which is that on the left-hand side, you can see that there's a traditional, it tends to be, and historically has been, a traditional allocation based on age. So younger you are, the more stocks and less bonds you have. Older you are, which is the fourth pie chart on the bottom right, you tend to have more bonds, more money market stable, and less equities. The interesting thing, though, is that with cash at zero and with fixed income, as I mentioned earlier, unlikely to return real returns after inflation, what it essentially means is the defensive aspect of the portfolio returns nothing. And that's often 40% of a 60-year-old's portfolio. The other thing is that the 50 or 65% of equities that you have some certain risks around them, which is that it just so happens that by the time you get to 60 or 65, and as of 2020, the ASX is trading on 19 or 20 times, which it hasn't done for 30 years. So, it's a problematic allocation here. And I think it's not drawing a long bow to argue that the models from endowments and family offices could be useful. In the right chart there, you can see on the left-hand side of that right chart, most advisors get around this by putting diversification in there. So traditional asset allocation structures feature, and this is also problematic, correlated assets. So within equities, you get regions, and that's that orange level. Within fixed income, you get high yield and emerging markets, treasuries, investment grade. Well, as we saw in March, high yield, EM, and investment grade credit provided no portfolio protection. And on the bottom left in alternatives, they just tend to have real estate and hedge funds. No private equity, no venture capital, no anything else. So the right chart there indicates that there may be a potential benefit from not just embracing it, alternative allocations from endowments and also from family offices, but it also may be better to look at your portfolios in terms of behaviours and correlations and the things like Sean was talking about before, Sharpe ratios, standard deviation of portfolios alongside return. So as you can see up there on the top, the blue section is growth. That's normally equities. So you've got equity regions, then you put in styles, market cap, high yield fixed income. You group that together because high yield fixed income has a correlation to equities of about 85 to 90%. In terms of defensives, you can look at investment grade bonds, but also you can look at unlisted private credit funds, which have higher yield. So they may be useful. Duration, in my bet, doesn't get a look in at the moment because owning long duration bonds is probably the worst bet of the century, in my view. And then on the bottom left is, you can't quite see it, that yellow area is unconstrained. So in that unconstrained area, that's where you can essentially go anywhere, seek out return, as long as it's well risk adjusted. And that would be where things like hedge funds come in, private equity, venture capital. So you can see that, and what I really wanted to do with these 3 slides was just provide a bit of a journey across what endowments are doing, what families are doing, and also what advisors are doing currently. And they're quite different. And you can see, just going on this side from the left to the right, how rethinking what you're doing, thinking about different styles, different correlations rather than the traditional norms may be quite useful. So if we take those slides down, please, Byron, we'll keep on moving. So the last 2 questions to the guys, and I'll try and make them reasonably brief. Sean, if an allocator is investing in an alternatives manager, what should they look for? And what are the pitfalls? So when you look at another manager or one of your peers and you examine their numbers, you go, oh, look, he's not doing this right, or he is doing this right. So give us the insider's view on what an alternatives manager, asset allocator should be looking at when they come to market neutral and long short.
Yeah, I think I might have prematurely touched on a few of these earlier on, but really consistency of returns, I think, and also how those returns are generated. So you can tell so much, like we mentioned Sharpe ratios and Sortino ratios, how much return you're getting for every unit of risk is very important, but you also need to be looking a little bit more in terms of how those returns are generated. So if you don't have attribution on the manager, that sort of analysis, you can look at the correlation to style indices. Are they taking a particular style bias? And certainly look if there's any beta correlation there, so they appear to be timing the market, those sort of things. So you really want repeatable returns from a manager. And as I mentioned before, the broader the investment process in the listed space, the more decisions you're making, the more likely your returns are going to be consistent and repeatable. So being able to analyse a market, a fund's returns and look at correlations to growth, style indices, value indices, the overall market, will get decomposition of the actual underlying returns and how broadly they're spread, and look at consistency over time, look at how that fund performs in up and down markets, consistency during drawdowns, is there a lot of leverage involved there? That really the things that I'd be looking at for other managers in terms of if I wanted to invest in them. It's really consistency, repeatability, performance, not necessarily just great performance over the last year.
And are there any red flags that stand out, or do you think may stand out to an asset allocator when they look at an alternatives manager? Like, do you have 1 or 2 things that when you look at a manager or a peer that you go, oh, he shouldn't be doing that? That's clearly not wrong. Do you have 1 or 2 particular things you can share?
I think a red flag for me is returns that are actually too good. So if a manager's turning up with like a Sharpe ratio of 5 or 10 or something, or really big returns, you sort of step back and go, oh, hang on, what sort of risk have they taken to achieve that? So that's actually returns that are too good. can be a little bit of a red flag for me as well. And certainly if you've got any attribution of where those returns are coming from, if they've all come from one or two big stock positions, would be a red flag. The other would be liquidity premium. So, if stock returns are coming from very highly volatile, more micro-cap stocks that can really swing around, so sort of hidden risk built into that sort of return profile, they all flag as red flags for me.
Thanks, Sean, and we'll pass over to Chris. So I think, Chris, you mentioned a couple of issues earlier. One is the inability of managers in the PE space to return liquidity. So that's probably one of those red flags. What are those one or two takeaway criteria that you want to leave the audience with today as to how to differentiate a good private equity manager or not?
Yeah, I think it's to Sean's point around disaggregating why their returns have been good. And I think primarily private equity is a long game. And so in a market environment of rising asset prices with the use of leverage, it is more straightforward to get equity returns in a private equity environment. And really the question is, if and when the tide goes out, really two things. Have they demonstrated that they have been thoughtful about how they invest in order to be market neutral in terms of their ability to create returns? And then I think secondly, good private equity managers know how to address issues. It's an active model as and when issues arise, either specific to a portfolio or a market-based issue. How have they demonstrated their ability to address those and deliver the same or comparable returns irrespective of that? And so I think those attributes of a manager really combined with a distinct competitive advantage, you can really point to why they're different in the market, I think are things to look for. I think on the things to watch out for, because it is a long game, you're looking for the right incentives for that team. And because there is lockup in capital, you're wanting to make sure that you're pretty aligned with where that investment team is heading and what they're looking to get out of the fund. And so often, I think in private equity, they say the easiest fund is your second fund, because you've raised your first fund, you've invested it, you haven't really had to prove yet if you've been able to get realized returns from that, and you're on to your second fund. And then all of a sudden, management fees are flowing. The difficult fund is your third fund, because by then you can't really fake it anymore. You have to have actually demonstrated that you've been able to execute and return funds to your investors. And so I think those dynamics, whether it's at that point in the life cycle, later in the life cycle, thinking through alignment with the managers and where they are in their life journey as well, I think is actually probably more important in the private equity, because your capital is being committed for the long term with that group of individuals.
Right, Chris, thank you. And Sean, thank you as well. I'll pass back to Byron, I think, for Q&A. I think we've got 5 or 6 questions out. Byron, it looks to me that I think a couple of those questions we've actually addressed in some of the guys' comments already, but I'll leave it with you to filter through them.
Yeah, thanks, Craig. So I think a couple of them we definitely have answered. There's a few left here though. So a question for Chris. So we're seeing investors are seeing a growing number of private equity opportunities, for example, large bulge bracket PE strategies, mid-market and sub-mid-market. Can you explain where you fit and why you believe the marginal opportunities lie, where these opportunities lie for investors considering allocating to private equity going forward?
Yeah, so we fit, I think in private equity, there's obviously the risk and return spectrum kind of is shaped by the nature of the size of deals that you're doing in your particular strategy. At the bulge bracket level, the size in which they operate, the type of companies in which they're buying, it is hard to get away from their ability to access cheap leverage and make that a significant part of their capital stack as being a key part of how they are able to derive value from their equity. And so that's a particular strategy, and it has worked well over time during most markets, but not in all markets. Where we sit in a mid-market sense is much more focused around building value into the investments that we make. And there is inherent, if you like, multiple uplift or valuation uplift in taking a business and turning it into something that's corporatized and ready for the next phase of its evolution. And that could be a listed market environment, or it could be one of those big brother private equity funds as well. I think where we then are not is earlier stage, we focus on good, profitable businesses, buying at very reasonable cash flow based multiples. Typically our downside is a longer hold with our capital preserved and returned via dividends, and so we then sit slightly different to a venture capital early stage strategy, which is looking more to make 20, 30 bets out of their fund and hoping a few of them turn into billion-dollar companies. And so our particular strategy is resource intensive, uses limited leverage, is operationally intense, and has execution risk associated with it. But we've tended to attract the interest of family offices in particular, which we talked about earlier, who are looking for fundamental valuations and also a lower risk profile in terms of the assets they invest in, and are also happy to sit in them for the longer term as well. And so I guess we like that strategy. It's one of many strategies in the market around private equity, and they all have their merits, but that's where we're positioned.
Thanks, Chris. Question for you, Craig. So when you're assessing private equity alternative assets investments, and the structure, I mean, there's been a lot of talk in this call just around, what's the best way to access private equity. There's been players that have come to the market offering, better liquidity terms. There's obviously, a cash drag on returns and the like. I guess, how do you look at that space? I mean, we've got Sean on the call in market neutral Aussie equities, and then, at the illiquid end of the spectrum with Chris. I guess just how you sort of think about that for sort of more advisors and maybe the lower level of wholesale rather than the family office and institutions.
Yeah, look, I mean, I think it's always the challenge incorporating liquidity and alternatives into a portfolio when you have bonds and equities, which are so liquid. What I try and do is make an assessment of whether the alternative asset class and the manager is likely to hit a return target, firstly. Secondly, from a risk perspective, think about what their drawdown profile is going to be. Yes, standard deviation volatility is less relevant for a long, illiquid, locked up strategy, but it's also, you have to find something that indicates degree of leverage, degree of, I think Sean touched on that, but also degree of risk. I kind of look at quite crucially at down periods in the equity market. So for example, March, December 2018, February 2018, and work out what actually happened in the monthly return stream of the manager. And that's the same as whether it's private equity or a hedge fund or a global macro fund or a CTA. And I think if you do that properly, then you end up getting to the point where you work out how that asset is going to perform, not just from a return perspective, but from a downgrade perspective or in an adverse market event. So I think that gives you a pretty good idea as to what the benefit is going to be from holding those assets in your portfolio. And the reality is that most of the private equity, and not all, but long short, there were some horror stories, as Sean would know, during March. But a lot of the market neutral guys actually did significantly better in March. And one of the reasons for that is because they have higher alpha, lower beta, lower correlation. So it's really important to build a framework with those decision-making criteria, those quantitative criteria, to be able to compare managers. And if you compare managers properly, then you can work out how durable the return stream is going to be. Sean touched on that. And then also what your drawdown stream is going to be, therefore what your Sharpe ratio is going to look like from a portfolio perspective. So you have to take a building blocks approach, in my view, across all of those different asset classes.
Great, thanks, Craig. That's really good. A question for all of you, actually. It comes up quite a lot as a BDM. Australian investors have a tendency to be highly averse to paying fees. Strategies in the alternative space are some of the highest cost in the market. What is the panel's view on fees in alternatives and the value for money that you get? Maybe starting with you, Craig, and then I'll let the other two answer the question.
Look, I don't really think about fees. It's not, that might be the last place I end up rather than the first place I end up. From an asset allocations perspective, it's what does the portfolio look like after fees, and from a return and risk perspective. So if you get that return and risk perspective right, then the fee outcome is rendered redundant. So that's my take on it. having said that, that's not to say that we haven't, put together haven't helped put together clients with portfolios of alternatives managers or low-cost ETFs, other managers in the middle cost. They have their own issues, but my sense is, clients have their own issues as to what sort of cost option they're providing clients, but or their own clients. But my perspective is that that's everything should be looked at after fees, and if it still cuts the mustard, then it gets in.
Thanks. Oh, sorry, Chris.
Yeah, I mean, I'd say as a lower mid-market private equity manager, we don't have a lot of funds under management. We have maybe a couple of hundred of assets and less than that in terms of funds deployed into our investments, and run a team of 10 here. It's a labor-intensive model, and so we're not. I think one of the aspects of fees in private equity is that over time, a 2 and 20 model has evolved to try, and managers have tried to make it stick at the upper end where they're managing $10, $15 billion funds. And that's a lot of management fee for a group of private equity guys. I think you need to look at it in the context of the manager, the strategy, the resources they're deploying, whether it's a reasonable set of resources to try and deliver the returns that they're looking to return over time.
Yeah, I agree, particularly what Craig said in terms of should always consider just after fee performance when looking at different managers. So I do believe you get what you pay for. So if you're looking for good active returns, you need to be prepared to pay fees to get that. And whilst fees are higher in the alternative space compared to passive exposures in products, they do give you genuinely high return with a bit of risk reward trade-off a lot of the time, and in a very diversified manner. But certainly looking at assessing your broad portfolio on post-fee returns is important. I find it fascinating that probably Renaissance, one of the most successful fund managers in the world, I think to get into the medallion fund, the fees, I don't know what they are off the top of my head, it's like $450 or something. Craig might know, but people are queued up to get into the fund.
I think it's something like that.
Yeah, and that's because their returns are sensational over a very long period of time. So high fees can be a measure of quality as well, but that doesn't mean to say there's a lot of dodgy players out there that charge high fees. It's definitely an agency problem. So between a client and the underlying manager. So good alignment in terms of making sure all the fee structures are there in terms of high watermarks. You don't want to encourage managers to take on risk and gamble with your money. So alignment, high watermarks, appropriate benchmarks are all very important things to look at when looking at fees and performance fee structures in the alternative space as well.
Great, thanks guys. That was really good. Craig, do you have any closing comments before I finish things off? No? Okay, great.
No, not really. Just thanks to the guys and thanks, Byron, to you and the channel group for putting it on. Hopefully it's been useful to everyone.
Yeah, thanks very much, Craig, Sean and Chris. And thank you all for your attendance. So that's the final session, as I was saying earlier, of the Channel Capital Asset Allocation Virtual Series. So we had sessions on fixed income, real assets and global equities yesterday and today. And we've put these together because we found that after talking to our clients that many were unfamiliar with the subsectors and asset classes and their important role to play in portfolio construction. So thank you all again for attending. It's been a very tumultuous 2020 and we're looking forward to working with you again in 2021. Have a good rest of the day. Thank you.
Thank you all.
Thanks, everyone.